Welcome to Markets in a Minute. My name is Austin Duke. I am financial advisor and chief investment officer for Diamondback Financial Services. We are an investment advisory firm focusing on clients who recognize the need for solid financial advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, March 31st, 2025 edition. Let's get started. All right, we start by looking at the stock market as measured by the S&P 500. This is an index of the 500 largest companies in America. Stock prices will go up and down on a daily basis for a variety of reasons. Our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. The prior 2-week period saw a decline of about 1.03%, which gives us a year-to-date gain of negative 5.11%. It looked like we were off to the races to start off the last 2 weeks, especially this last week. There was an article that I read on Bloomberg suggesting that the tariffs that President Trump was considering were not going to be as bad as anticipated. That came out over the weekend, and so the market started off the week relatively well. I believe it was Wednesday he put on or announced the auto tariffs. And then we had some economic data, inflation data, and consumer sentiment, consumer confidence type economic data that really led to the sell-off here at the end of the week, which we would have had a gain for the 2-week period if it hadn't been for the sell-off that we had on Friday. Next, we look at interest rates as measured by bonds issued through the U.S. Treasury Department. We believe that interest rates are the preeminent measure of investment risk, and rates are factored into every valuation, including stock valuations. So rates will go up and down on a daily basis as well for a variety of reasons. And so we want to see what moves we've seen, why we've seen them, and ultimately where we think we're going from here and what implications that has for stock prices. Now that it's March 31st and it's the end of the quarter, so we kind of want to take a look and see where we've come over the last 3 months. So this chart shows us here interest rates listed over here on the left, and the maturities down here on the bottom from 1 month all the way out to 30-year maturities. And then each dot on the chart gives us an interest rate for a given maturity length. So the solid green line is where we ended on March 28th. The brown line is where we were just 1 month ago, and then this dotted green line is where we were at the end of 2024. So we can see that not a lot of change here. If you have interest rates on bonds that are maturing in less than a year, pretty much the same now as they were about 3 months ago. But here in the medium to long-term range, we would say a significant decline in those interest rates, suggesting that people are buying bonds and they're trying to capture those higher rates that we don't anticipate are going to stay around forever. And interest rates and bond values have an inverse relationship. So if interest rates are going up, then the value of a bond is going down, and vice versa. So if interest rates are coming down, people are buying bonds and those values are going up. So Federal Reserve had their meeting on March 13th, and they made no changes to the Fed funds rate and basically signaled that they're not in any hurry to make any changes. They want to see what the economy is going to do, what actual tariff policies come out, and what they think impact might be on inflation. And so they're kind of in a wait and see mode, and hopefully we get some clarity on that pretty soon. But for now, this is what we're dealing with. Getting into our investment implications and expectations portion. We started out 2 weeks ago with a chart like this. 2 weeks ago, it was a 7-year chart of the stock market. This time it's only 3 years because we want to put a little more emphasis and attention on recent events. But as a recap, we see declines of 5% or more about 3 times in a 12-month period. We'll see one of those become a 10% decline about once a year, and then we'll see 20% or more once every 3 years. Again, variety of reasons why those happen. Most of the time, we remember it when it's happening, but we'll forget about it after the fact. But they are normal, natural, healthy adjustments in the stock market, right? Everything goes up and down, and we just know that over time, the majority of the time it goes up. So we've identified a few of these, right? We had a 10% decline here back in 2023, and that's the last time we had one until just recently, and a couple other 5+% declines that we had in 2024. Right. So in 2023 and in 2024, we had gains of over 20% for the year, but we still had these pullbacks, these short-term declines that happened, again, for a variety of reasons. And it shouldn't give us reason to feel like the world is ending, but this is something natural and normal and should be expected. And when it happens, we can take advantage of it. Something that we had discussed, this green line is what we call the 200-day moving average, which gives us an idea of the trend of the overall market. And as long as that is going up to the right, then we know that the market is healthy and we're happy to be invested. If it's coming down, then we know that we're in a downtrend and we're less likely or less willing to be fully invested in the stock market. So coming out of 2022, we were able to get this moving average to come positive. It could be rolling over here and flattening out. Time will tell. But we had mentioned that the stock market had dropped below the 200-day moving average. And 2 weeks ago, we were at this bottom point. And we said that we anticipated that we would be able to get back up to the 200-day moving average, which we did at the beginning of the week. And then we were going to wait and see what happened. If we could get decisively above the 200-day moving average and keep going up, then that would give us confidence that this is just a short-term hiccup and we'd be on our way. If we dropped back below, then we felt like maybe this could be the setup for a 20% decline, or maybe we would just kind of waffle around along the 200-day moving average, and we would lack certainty in either direction. So it appears that we got back up to that 200-day moving average, and then we bounced right off of it with more tariff announcements. And we're hoping for, again, some clarity on what tariffs are going to look like this week. April 2nd was the day that President Trump was going to announce the reciprocal tariffs, and he had delayed tariffs on, or the additional tariffs on China and Mexico and Canada. And so we're hoping that we feel like we just need some clarity. We need to know what these policies are going to be so that companies can make adjustments and then we can get on with business as usual. In 2022, it felt like that entire year we were waiting for the Fed to decide what they're going to do with interest rates, because they kept telling us like, well, we don't think we need to raise interest rates. And then they would raise them 75 basis points, and they would do that multiple times. And so we never felt like we knew what the actual policy was going to be, what the actual interest rates were going to be. And when you're trying to make business decisions and you don't know what interest rate you're going to be borrowing or lending at, it makes it really hard to do business or to make accurate forecasts. So it would be very nice if this week we could actually get some clarity. It may result in a little bit more pain in the stock market. That's tough to know because it all just depends on what those actual policies come out to be. So we're going to have to wait and see. I would like to give it, one more week to determine what we think is going to happen and then kind of go from there. Final note on this is I've got this white line. It also helps to draw some extra lines to kind of see what trends we have going in the market. This white line represents what we would consider like a healthy average growth rate for the stock market, long-term growth. And again, 2023, 2024, we had over 20% gains for the market, which you can see we're a little bit at a higher trajectory than what we would expect for a long-term average. So the Magnificent Seven, as we call them, the 7 stocks that were really leading the charge and a lot of the artificial intelligence space haven't done as well so far this year, which has kind of helped with that 10% decline. But we can envision a scenario where if this does end up leading to a 20% decline, we would go from about the 6,200 level down to around 5,000, right? That would put us at about a 20% drop and consequently put us right in line with this long-term average growth rate. So I'm not predicting that. I'm just saying I wouldn't be totally surprised or even concerned if we did see a correction that came down to this level. It doesn't mean that, again, the world is ending. It just means we've had a correction. The market tends to heal itself. And then once we've been able to do rebalancing and buy into stocks and other securities that have become a better price, they've gone on sale as opposed to where they were here in February, and the market can continue. It's not uncommon for us to have significant declines in the stock market from one year to the next and still end up positive for the year, right? If I take a look, so 2008 financial crisis was a bad year. If we look since the 2008 financial crisis, we started 2009 with a 28% drop, right? It was about March of 2009 when we finally hit the bottom and the stock market advanced higher. 28% drop in those first 3 months. We still ended the year up 23%. And you can see three years out of four, 75% of the time, we have positive years in the stock market. Last 2 years, 24, 23%. That's not sustainable growth. And that's why we end up having a year where we have a 0 or a -1 or a -6, right? -19 was the year that they were raising interest rates, and we had a really hard time figuring out how to invest. But most of the time, we're getting double digits, right? 10+% returns, even 20, 30% returns. And just because we have a start to the year that goes down 10+%, like, it doesn't mean we can't end positive for the year. So in my opinion, let's just get it out of the way now, and then let's be on to bigger and better things going forward. The last thing I wanted to share on the implications portion, there is a group, economic research group that I follow. That's called MRB Partners. They provide me with research almost on a daily basis, these research papers. And so I try to read through as many as I can because I feel like it's really good stuff. But as mentioned, on Friday, we got what's called consumer sentiment or consumer confidence data. And we're seeing a pretty significant divergence between actual hard data of what's happening in the economy versus what the consumer feels is happening in the economy. So these consumer confidence surveys are people expressing their concerns about job security, about interest rates, about inflation rates, what they feel is happening or what they feel is going to happen in the economy versus the actual hard data of this is, how many things were bought and sold and, did the economy grow or not? And so it's just, we're seeing a pretty significant divergence between what people are feeling about the economy versus what's actually happening in the economy, right? The unemployment rate is still very low. We're not seeing a lot of people losing their jobs. Jobs plentiful minus jobs hard to get. Actually, it was up in March, and so again, we're kind of feeling like it's a tale of two economies, and we still keep our eye on it because how people feel can translate into what they actually do, and where we know that 2/3 of our economy are consumers spending money. It could, right? If people feel more safe and secure in their jobs and their income, then they tend to spend more. If they feel more concerned about where the economy is going, then it leads to us to believe that they could cut back on spending or that they would just shift their spending. Or if there's tariffs on cars, are they going to be buying used cars? Like, so there's a lot that goes on into it. But I highlighted what they put over here, where basically the risk is if their expectations actually translate into the hard data. Like, we actually start seeing the unemployment rate going up because businesses are letting people go because they're not sure if they're going to have the sales to support the staff, et cetera. Then those are the things that we want to be keeping our eye on as we go into the summer. Ultimately, looking at corporate profits, corporate guidance when they announce earnings. We're gonna start the second quarter earnings here in about 2 weeks. Or sorry, the first quarter earnings will start in about 2 weeks. So we'll get more information from these companies and what they're thinking about the future and about tariffs, et cetera. And we'll get a look at unemployment rate, and we'll see where we go from there. We still don't think the Federal Reserve is going to cut interest rates at their May meeting. We think the first one will come in June. We think that once we get some of the clarity on these tariff policies, that there will be some adjustments in certain sectors of the economy, and there could be an increase in the unemployment rate that leads the Federal Reserve to come in and say we're going to cut rates to try and keep the economy going. That's kind of our base case at this point. All right, as a final word, this has been a lot of fun. I've had a good time putting this one together. I hope you guys have enjoyed it as well. Um, Again, it's March 31st. We're coming up on the end of what we call March Madness in the NCAA college men's basketball tournament. As a ritual, there are millions of us who put together a bracket. There are 68 teams, really 64 teams, that we will try to make predictions of who's going to win each game all the way through to the championship. And no one has ever put together a perfect bracket. It's near impossible. Well, so far it's been impossible. Right? Statistically, theoretically, we could do one, but no one's done it yet. And typically we'll see the best teams in the nation that get the number one seed are the ones that we predict are going to end up winning it all. And more often than not, somebody who's either ranked number one or number two ends up in the championship, ends up winning it. But something that we really enjoy watching for is one of these teams that's ranked all the way down 13, 14, 15, 16, and whether or not they can come up against the juggernauts, right? The David and Goliath type of matchup, and if they can beat them, and not only beat them, but see how far they can make it, how close to the championship they can make it. We call those Cinderella teams. And anyway, so my bracket was busted. The very first game I got wrong, so I did not have a perfect bracket from the very first game, which really allowed me the opportunity to kind of sit back and say, okay, well, all that stress is gone. I'll just try to enjoy the tournament. BYU is obviously a team I like. I went to school there and follow that team. So they made it through the first couple rounds, and then they lost in the round of 16. But Duke is the other team that I am following. They were one of the first that I remember when I was a kid. They were winning championships when I was first coming on the scene to watch sports, and it just made it really easy. Like, hey, it's my last name, and they're a good basketball team, and I like basketball, so worked out pretty well. But I think if we were to try to relate that to investing, right, when we put together investment allocations, like we're going to have the juggernauts, we're going to have the number one and two seeds that perform well, that we think are going to make it all the way to the championship. And then we try to spend the rest of our time identifying those Cinderellas and try to say, okay, where are the other areas of opportunity, the sectors or the companies in international countries, or where do we want to put the rest that we could probably get a little bit more investment return than just sticking it all here and putting it all on the number one seed. And so it's a lot of fun. We don't always get it right? Sometimes our bracket gets busted on the first opportunity, but it's part of the reason why we love doing what we do. And we always love using the sports analogies because we love sports. And anyway, so hopefully that resonates with you. And I'll just make a note that for most of this first week here of April, it is spring break, and I will be vacationing with my family. I will have my laptop with me in case anything comes up that's an emergency, but if there's nothing that is absolutely necessary, then I will do my best to get to it when I'm back in the office after spring break is done. But I appreciate all you guys, appreciate your support and sticking with us, and we'll continue to do our best, and hopefully we get some good news out of the Trump administration this week, that the markets are happy, but we'll see how it goes. So have a good week, and we'll see you soon.